Hey, my name's Rajesh. I'm a direct lender based in Los Angeles, and today I'll be looking at the mortgage trick that banks hate. So let's take a look at the video first, and then I'll give you my take.
Your typical homeowner pays 2 times for their house. Once for the house and once for the interest on the house. But rich people skip that second payment. And if you stick with me, I'm going to show you how too. By the way, I'm Mel. I teach people how to build conscious wealth. If you're into that, hit the like and follow. Okay, so the first thing that you need to know is a 30-year fixed rate mortgage is not a loan. It's a profit machine. Say you borrow $500,000. Well, you'll end up spending over $1 million over the course of those 30 years. And half of that is pure interest at the banks. And this trick is simple. And despite what your mortgage broker might say, you don't need to refinance. You just need to break the payment cycle that the bank designed to keep you in debt. Let me show you what I mean. So take the amount of your principal and interest, not the taxes and insurance. And let's say that's $3,600. Now you take that $3,600 and you divide it by 6. And that math is $600. Now you take that $600 and you make a mid-monthly payment of principal only. It's a small, consistent effort that's laser focused on reducing your debt. And maybe you're wondering, how does this even work? See, mortgages compound your interest on the remaining balance. And by paying off your principal twice a month, you can actually shave off a decade on that loan. Double that payment and you can turn a 30-year mortgage into 15 years. And that's without fees, a refinance, or your bank's permission. But your mortgage broker's never gonna tell you that. Banks hate this strategy, not because it's illegal, but because it's not profitable. Because banks make money on your patience, not your payment. Most banks are gonna tell you to refinance because it restarts the clock on their profit cycle. So don't fall for that. If you want more tips like this on how to build conscious wealth, then hit the follow button, and I'll see you tomorrow.
Yeah, so a couple of things. What is she right about? She is right about the fact that with interest taken into account, you are paying about twice, generally speaking. So let's say you have $1 million home, or $1 million loan rather, and you put 20% down on a $1.2 million home. That's, let's just say you have $1 million loan, or let's say $800,000, right? You buy $1 million home, you put 20% down, that's $800,000. And right now rates on a conventional loan are roughly 6.25, maybe even 5.99%, okay? 360 months, your principal payments are $2,200, your interest payments are $2,500, your monthly payments are a little less than $5,000 or $4,800 on just the principal and interest. Total interest paid is total paid is $1.7 million, which is a little bit more than 2 times, the original cost of the loan, but less than twice the cost of the home. So $700,000 more than the cost of the home. That's 215% more than what the house cost, right? So let's see another way of looking at that. That is a lie, and it is profit for the interest collector. But she's wrong. That banks are against this. She's absolutely wrong about that, because what happens is when the bank lends you money, they've made money on the origination fees, they've made money on the underwriting fee, the processing fee, and then they take that loan along with millions of other loans, and then they sell it to Fannie Mae and Freddie Mac, which right now are controlled by the government. And then the government gives money, because that's what a sale is. They take money and they give it back to the bank, which they can re-lend out. And the person collecting interest isn't the bank. They act as servicers, but the people collecting interest is Fannie Mae and Freddie Mac, because they own the note. So the banks don't really care if you pay the loan off early or not. They just care that you pay. What's worse than somebody who pays their loan off early is somebody who does not pay their loan at all. And the other thing I want to talk about is, that's exactly how interest amortization works. So if we look at, for example, this interest saving calculator, we'll do the same exact thing here. $1 million, right? You got $1 million home. You've got an original mortgage balance of 800,000, and you've got 800,000 left on the loan. Okay, closing costs, we're going to put 0, keep it equal, right? No upfront mortgage interest, because this is going to be a conventional loan with 20% down or 80% LTV. Here's a 30-year term. We're going to use a 5.99% interest rate. 5.99% interest rate. And then monthly mortgage insurance will be 0 because it's a conventional loan. Here are escrows, which for now are, let's just put 0 and 0, so that we're getting an apples to apples comparison, right? And let's go to bank rate mortgage calculator. So we go here, $1 million. Down payment is 20%, 6.99. And let's zero this out right here. Zero this out right there. And this says 6.99, 5.99. All right, so let's see here. $47.91 a month. $47.91 a month. $47.91 a month. Everything's been equalized, right? So let's see what our amortization schedule is looking like. And here are these charts. They don't really make sense, but here's what she said. The more you pay towards the balance, the interest is being applied to a smaller balance. As a result, your interest payments go down, and a bigger part of your fixed monthly mortgage payment is applied towards the principal. Yes, that is true. That's why the first part of what she said is correct. By applying extra payments towards the principal, you're paying that down sooner, and you are going to save time. So this is how much interest you are paying over the lifetime of the loan, $920,000 roughly. Mortgage acceleration calculator. So we're going to do a comparison of doing a refinance versus, just paying your mortgage off or paying extra payments on the mortgage like she suggests. So let's see what this looks like. So we've got a 30-year mortgage. This is not the calculator. I believe this might be it. I might be wrong though. Okay. So let's see. Loan amount is $800,000. 30-year term, 5.99. Extra payment. Let's say we are doing, if according to this, what she's saying is split the payments up into smaller chunks. So she's gonna, I'm guessing she would say pay $1,100 at the start of the month and $1,100 at mid-month, or put $1,100 a month extra towards 1,100. Okay, so what is half of this? That's all 11s, or all 1s rather. So we're going to put, where is this number at? There we go. Oh yeah, this is bank rate. They have that built in there. Awesome. 11.11. They're doing whole numbers only. And so here's your interest paid, right? If you're doing this, you're going to shave about supposedly 10 years off your loan. let's see, if we do 0 over there, it's 2056, 1111. So it actually shaves 12 years off your loan. So you're now on a 17 an 18-year mortgage. 2044 minus 2026, you're in an 18-year mortgage. Now let's say you just do a refi into a 15-year mortgage and your rate drops down to 4.99. Here's your interest savings. You were paying $924,000 in interest. Now you're paying $338,000 in interest. That's a $586,000 interest return on savings. You're going to be paying $1,500 more a month. So now we're just going to say, okay, well, instead of paying $1,100 a month, what if we just paid that $1,530.92 every month? $1,531. Let's see how much interest we save here. So total interest paid is $486,000, whereas total interest paid here is $337,000. Your total cost, so let's do some quick math here, because this number looks bigger than this number to me. So will this loan be done in 15 years? This will be done in 2042. So 2042 minus 2026, that's 16 years, whereas refinancing into a 15-year loan will be 1 year less. So you're going to save about $100,000. Let's see here, $150,000, 468,035 minus 337.92, 337,992. Well, let's round that up to 3. So you're going to save $130,000 by refinancing into a lower loan. So that's if this loan costs you 0, right? So let's say there's an origination fee and they charge 2 points. And then there's closing costs, $20,000, right? It's not going to be $20,000, but let's say it is 20. Well, on a loan this size, you're probably looking at closing costs of somewhere like $7,000. Okay, so now the cost of the loan is $23,000. Your total interest paid went up because the loan amount slightly increased, right? Because now your loan amount is no longer $800,000, it's $823,000. But you know, your interest rate is lower, and you're still at $347,000 in interest paid. Whereas here, your total interest paid is $468,000. So even though there's a cost to the loan, there's a bigger savings. So if we were to look at that return as an investment, if we were to think of that total loan cost, $23,000 as an investment, you're getting, you know, an extra $100,000 in savings on that. That's a 5 times return. If we were to look at the total interest savings over the lifetime of the loan, forgetting the comparison to just paying extra, that's almost a $600,000 saving. That's an annual compounded ROI of 18%. Those are Warren Buffett style returns at Berkshire and Hathaway. So let's say you're like, forget that comparison is not realistic. We'll just pay that extra $1,500 every month at the mid-month. Okay, great. Well, if you do the refi, you're still saving $130,000, right? So let's take this new number here, 468,035 minus 347,769, $120,000. And now we divide that by the cost of the loan, which is right here, 23,140. That's a 5x return. If we were to multiply that by 100, we can get that in percentages. That's a 519% return on your investment. So what I don't agree with her with is this anti-profit speech. Here's my belief. Here's my belief spelled out simply. Let's say it costs me $1 to get 100. Okay? So I have to spend $1, but then I get $100. That's a $99 profit. That's awesome. But am I really going to complain if this price goes up and then it becomes $10 and I still only get $100? Now my profit is 90, but I'm still winning. Now let's look at this differently. Let's say I spend $10 and I get back 20. Should I still do this? My profit is $10. Should I still do this? My personal answer is yes. I should still do this because I'm still making money on this. So for me, it's not about what it cost versus return. And so this is a philosophical question, not a binary yes no answer. And so this is why I got no hate for this influencer. I believe her name is Melissa Dorman. Very smart lady, obviously, because she's figured out the math behind this. What I disagree with her is the philosophy here. And so for me, cost doesn't matter because this is the thing that matters to me, return. This is the thing that matters. So for me, it's what am I getting back for that money? I don't have a problem with banks making a profit. What am I getting back for their profit? That's the thing. If I get a house that I could not afford in cash, then yeah, please charge me double over the long term, because now I get to put less money down. I get to make monthly payments that, according to federal law, thanks to federal law, has to be affordable to me. So if I don't max out my home buying capabilities just because I can't afford something that is twice my or half my paycheck, doesn't mean I should be getting something that's half my paycheck. But if I get something that's 25-30% of my paycheck, and then I only had to put 20% down, 10% down, 3% down in order to get that thing, then yeah, please make all the profit you want over 30 years. It's still going to take me 30 years to finish paying it. One. And two, if I can refinance into a lower interest rate and a lower term, to me that just makes sense. Because now I'm saving that additional $100,000 here, as you saw with the example that I gave you, using actual numbers right here. So here's your interest paid over a 15-year loan. And if you were to make that same extra monthly payment of $1,500 every month, well, this is $1,713 now. So let's see what this looks like. 1713. Does the term get any shorter? This is still 2042. So let's see, 2042, 2042 minus 2026. I'm still at 16 years. This is still at 347. My interest is at 443. So 443, 320 minus 347, 769. That's $95,000. That's slightly less, but it's still a lot of money. If I were to give you $95,000 right now, you're not going to complain. So if I were to divide that by 23,140, what is that? That's 4x. I'm still 4xing my money. Why wouldn't I do that? It's a no-brainer. Just because I'm not doing this doesn't mean this is a bad deal. I would do all three of these deals every day with my eyes closed. So it's really about, philosophy here. Is paying X worth, let's say, X times Y? So for me, I would do this deal if I were to pay $10 and I got back $15, I would do this. If I had to pay $10 to get back $11, I would do this deal. For me, it's about what am I getting back for what I'm paying. It's not about the fact that I have to pay. It's about what am I getting in return for that money. Anyway, that's the end of my rant. Thank you. And thank you to Melissa Dorman for giving me something to talk about. Respect.